I've heard many entrepreneurs say, and I'm glad we didn't get an excessive valuation, like you said,
Yeah.
because the VCs had wisened up around the valuations of fintech lending. Most entrepreneurs are saying, hey, let me max out on the valuation
Yeah.
because they're accomplishment oriented and they measure that as a mark of success as opposed to growing profits because they read the headlines around them. And if they're not keeping up with the Joneses, their peer group in SF, then they feel like their idea lacks validation.
I was in that category also. I think it's just my natural inclination that I've always been like outcome oriented. And I always thought, like, if I raise at 50x ARR, how am I going to get an exit in the company that's valuable to my investors and to ourselves also?
Why is that? Why does the math of raising at a 50x ARR, which is a high valuation, hurt the outcome when you might look at that as a marker that you're on the path?
Valuations are always ahead of value created by the business. At least that's what I believe in, especially in the early stages. If the valuations are too far ahead of the value and the value never catches up, the fall down is super demotivating for the founders, for the investors, for the team, and broadly for the ecosystem. If something's valued, like I saw a company today, the news came out in information security startup valued at 8 billion, being sold at 150 million. And I can't imagine how demotivating it is for the employees who bought into the vision of a company and they're taking so much risk. I think it is also not fair to the employees who are taking a very high risk joining.
Well, their options are worthless. And what happens, maybe explain for our audience, what happens when you raise at that high valuation and you sell for less money that you took in? Who gets paid out first?
We actually had the longest stack on top of us as we sold the company. So first, all the debt investors get paid. So if the company took any type of loan or corporate debt or asset-backed debt or whatever, they get paid first. Then you have to make sure that all the employees, at least payroll and things like those, like vendor bills, are paid. Then preferred investors get paid. So whenever someone raises money, all the investors get preferred stock. All the founders and the employees have common stock and options.
And they're last in line.
They're last in line. Employees are even after the founders in many cases. So if between debt and bills and preferred investors, if all the money goes there, you don't make anything.
The employees don't have restricted stock. They have options, which have a strike price. And another way to simplify is like last money in gets paid out first. VCs call it lick pref, or it's liquidation preference. It's a structure in you call it the capital stack that protects new money. And it's a funny dynamic because that structure also makes it easier to accept new money because new money can say, hey, look, if we're paying too much for this, look, we've got preference. We're first money out. We'll get put back to par. We'll get our funds back.
Right.
And that story keeps going for the next investor and the next investor. So that startup you mentioned, $8 billion valuation, sold for $150 million. I don't know how much money they took in. That last investor may have done okay. Probably not, because they probably raised multiples of $150 million. But they got a couple of cents on the dollar back. And now they have to do this painful recapitalization, depending on what happened with the business, which is something that private equity firms do all the time. VCs don't like doing that. By that point, the VCs checked off the board. They're not there. They're working on the next team, the next startup. So what were the valuation multiples that we saw in 2021?
I think average like 50, 100x ARR for SaaS companies growing at 100% year over year.